All right, guys, welcome to Next Level Trading. Here we got our next edition. We'll be talking about trading the market now. But first, before I get into that, I want to start off by talking to you guys about spread. I know I wasn't able to catch it last week, but let's go over what spread really is. And so, what is a spread, you may ask? Well, it is the difference between a bid and the ask price. It is how the broker gets paid, being that they are charging a fee in order to place a trade for you to get into the market. It varies with different brokers, pairs, and sessions, so the spread is always changing. It's never really constant, depending on the session you're in, depending on the broker you have, depending on that particular pair you're trading, the spread will always be changing. So you always have to, look out for that. But yeah, so keep that in mind. Now, whenever you make a buy order, broker makes a sell order and trades against you. So whenever you do a buy, you know, do know that you have to sell in order to close that trade and vice versa. And so I'll touch up on that on the next slide as well. In order to calculate the spread in this example, you simply just subtract 1.3817 from to 1.3815, and that will give you the spread, which will equal 2, meaning that every trade you take, you will start in a negative 2 pip deficit, or will have a 2 pip barrier that you will have to overcome. Now, buy order will be going for, in this example, a buy order will be going for 1.3815, meaning that that's the price that the broker is willing to sell for. Okay, so they call that a bid. Now, so whenever you see the bid, just think about the price that the broker is willing to sell that to you. I mean, if you go into a regular store and you want to buy bananas, that store is selling those bananas for 99 cents, and you're buying those bananas for 99 cents. So it's the same thing here. You want to make a if you want to make a buy, you got to first get the ask price. I'm sorry, I had to switch up. You have to get the ask price. So the ask price here would actually be 38.17. So 1.3817 will be the ask price. And then if you want to make a sell, you have to look at the bid price. And so 1.3815 will be the bid price. So just by simply subtracting the two will give you the spread. And in this case, it's 2. So once you click buy or once you click sell, you'll be in a negative 2 pip deficit. But once the market goes in your favor, let's say 20 pips, you will overcome that and you'll be plus 18 pips. So, the spread is really just how the broker gets his commission off every trade that you make. Now, granted, you do get it right back, if your trade goes in the right direction. But just keep that in mind, whenever you guys are making orders. I mean, spreads really aren't that big of a deal unless you're trading exotic pairs. Exotic pairs usually tend to have big spreads, like NU versus the Swiss franc, or let's say New Zealand CAD versus the Swiss franc, or the Swiss franc versus, let's see, Aussie USD. So those type of pairs you wanna kind of be careful with, because their spreads can be quite high almost all the time. But if you're trading the major pairs, EU, UJ, GU, for the most part, the spreads will be pretty fair. It won't be too crazy on you. But just keep that in mind. All right, so now when it comes to trading, there's a lot of different ways you can get indicators as to where the market is going. And I'm going to talk to you guys about trading high probability chart patterns in the market. As I just mentioned, there are many different ways you can predict whether it is time for you to buy or sell a currency pair, and trading patterns is one of them. Now, the patterns won't always be pretty, so keep that in mind. These drawings, these images you have here are all setups to where they're all indicators and setups for you to enter a trade, but they won't always be as pretty as, for example, this head and shoulders on the right hand side. Sometimes it'll be a little, hard to figure out, but over time, as you practice, your eyes will become used to and adjusted to, seeing these different patterns, and it'll be second nature to you guys. You guys will be able to, attack the market. Now, let's talk about double top and bottom formations. So they're also known as M or W formations. And what they usually do, they show a pair struggling at a certain price level. And so let's talk about the double top. So as you guys can see here, can you guys see my mouse? Let me know if you guys can see my mouse right now. Okay, awesome. Awesome, cool. All right, so here's a double top pattern right here, okay? And so how the double top works is price will start from the left and rise. It'll go in a bullish trend all the way up to a certain price level. It'll bounce down from that price level and then meet the neckline of that M, creating its first leg, its left leg, and then it will rise up back to that previous level, that previous price area, and then drop again. And the second drop is where you want to make that entry off the neckline. And so let me go over that again. So price will rise at a certain price level, it will come down and then rise back to that same price level. It's almost as if it was a basketball that was bouncing down from, let's say a rooftop, or there's a brick wall here and price just can't break it. So price will rise, come back down, and then rise to that same level, but have trouble, and then you can make a sell. You could make an aggressive sell there, but I wouldn't recommend it. But the most safest way to make a sell in this particular pattern will be off that second leg, right at the neckline. So immediately once price hits the neckline, it's where you want to enter for that sell, and just ride that all the way down until you start to see bearish or actually bullish patterns, and we'll talk about that later. So here's how it looks on a chart. The second image, as you guys see here price rises, it comes down, and then it goes up, but it doesn't completely go exactly to the same level. But after, and that's why I kind of don't recommend you go for a sell, because you just never know where this second leg will stop at. But like more particularly, once price comes back down after the second leg, it comes back down, right here will be where you want to enter for a sell. And so the double top usually gives you your sell opportunities. Okay, now if you're looking for a buy opportunity, this is where you'll look into your double bottom. And so the double bottom is just like the double top, but it's just the opposite. So price comes down to a certain price level, it rises to a certain price level, then it comes back down to that same price level almost, and then it'll rise back to that neckline. And once you see that, all right, Brian told me that once this pattern is once it's developed, once this right leg is done, and it comes back to his neckline, Brian's like, okay, he told me to make a buy, because this is a bullish pattern. The double bottom is a bullish pattern, so that means you'll be making a buy. And so you expect price to shoot up from here. And so here's a example in the market. So price comes down, as you guys can see here, price comes down, it goes up, then it comes back down almost to the same level. But notice how it comes back up again, and then right here at this neckline, now that this whole second leg has formed, you have two legs, you're not able to see a W pattern, and you want to enter off this neckline. Right off this neckline for a buy opportunity, because double bottoms usually produce bullish trends, okay? All right, so now let's talk about triple bottom and top formations, okay? So now this is even better. You know, you don't just get one tap. I mean, you just don't get one or two taps. You get three taps. You know, that's better. So that's just more confirmation. You know, as you guys see this little red channel at the bottom, it's kind of, you can look at it as a brick wall. You know, like price is just struggling right there. And you know, it just shows this pair, which is the Australian dollar versus US dollar, really struggling at this price level. So price comes down, it bounces up, comes back down, bounces up again, comes back down for the third time, and man, I'm buying this because the triple bottom always creates bearish you know, patterns. And so what you pretty much will call this is support. And so it's created support, and you know, and that's a term, you know, every trader use when they see price struggling at coming down and struggling at a pattern. They call this support. Now price was struggling at the top of this line, they'll call that resistance. And so price will come up, bounce down, come back up, bounce down, come up again for the third time, and then you'll go for a sell because you know that's the third time's the charm, right? So you know, they call that, so let's say we have price struggling at the bottom, you'll call that support. And if price was struggling at the top, you'll call that resistance. So here if I were to draw a line at the very top, this would be my resistance, because price is bouncing down from the, price is bouncing down from that area. Now on this right picture, you know, you'll consider that your support because price is bouncing up. So it's going down and it's bouncing up, it's going down and bouncing up. So that you'll call, if you could draw a line, you will have like a support ordeal. So you want to keep in mind the definitions of support and resistance, because those are very important, especially when we talk about consolidation. But yeah, so triple bottom, triple top formations, I mean, they're even better to me. You know, the triple top is just the opposite of the triple bottom. So they're the same exact concept. It's just you know, the opposite of each other. Voila. But wait, there's more. We can even have a quadruple top or quadruple bottom, okay? So like going back to the support, price, as you guys can see, is coming down and bouncing up, coming down and bouncing up, coming down, bouncing up, coming down and bouncing up. So whenever price, I mean, is almost as if there's a brick wall. And so this kind of lets you know where the market is going. You know, once price comes around here, you know, hey, you know, for some reason it's struggling at support and you're expecting it to go up. So you'll do a buy and profit. So, you know, you can really just look at markets just by looking at a market, and I call that naked trading. You know, you really don't need no indicators or anything like that. You just look at a market and just see, you know, price action with these candles, and I'll get into that later on. But you look at the market and see price action at a certain level and be able to tell where the market is going to be at. You know, you can be able to tell, you know, what the market is going to do. So, you know, just taking that into consideration. Now, another pattern you can trade in a market that can, you know, give you some pips and some money, make you some pips and money, okay, but mainly pips. Okay, we want to focus on pips. Is this pattern called head and shoulders formation. So, you know, you can have a head and shoulders formation, which is this image on your left hand side right here on the left part of the screen. These two images are head and shoulder formation. Now you can also have an inverse head and shoulder, which is just the opposite. So it's just like this pattern is flipped upside down, and you know, you know, head and shoulder usually used to signal the reversal of a bullish pattern. You know, so if you have a head and shoulder, you have market has been going up, going up, going up, then a head and shoulder pattern forms. That means that pattern is about to reverse, because it's kind of just like a crown too, or like a little mountain. But one thing you want to keep in mind is that this second leg and the third leg is always smaller than the middle leg. You feel me? So that's why you call it a head and shoulder. because it looks like a head and shoulder, you know what I'm saying? Or it could be a crown or whatever. But usually price will come up, you know, it'll be on the bullish trend, and then it'll come up, come down to a certain price level, then go even higher than the first leg, come back down to that second level, okay, and then come up again to create the third leg. Once it comes back down to this neckline entry, okay, well, we guess what pattern has just formed? Head and shoulders. And Brian has said whenever we have a head and shoulders, that creates a bearish market, meaning that we have to sell. So right out this neckline, we'll do a sell, an entry for a sell, and then just ride that until we see bullish confirmation. And so here's a pattern, and this is how it looks, you know, on the actual chart. So as you guys can see, the market's been going up, right? Then it comes down to a certain price level. Then it comes back up higher than the first leg. Then it comes back down to that same price level. Then it comes up a little bit more, creating your third leg. Then it comes back down, and bam, look what that's formed. A perfect head and shoulders. So you want to enter off for a sell, and then just let that ride until you see other confirmation that price is about to reverse. And so the head and shoulders usually the end of a bullish run. You know, it means that, okay, it's time to stop buying and let's start selling, pretty much. Okay. Now we also have the inverse head and shoulders, where you know, it's just the opposite. So we're having a bearish run, price comes down, then it comes up to a certain price level, then it goes farther down, and it comes back up to that same level where, you know, it was just that, creating your second, your head, and then it'll create your shoulder, your next shoulder. And right when that last shoulder is done, you'll notice that the shoulder head shoulder pattern is formed, and that, you know, Brian said enter off the neckline of that pattern, right? And so you'll do a buy, because an inverse head and shoulder usually signals the reversal of a bearish pattern. So instead of selling, we'll be buying. So here's So here's an example on, you know, the chart. So price is dropping, and then it comes up to a certain price level, okay, creating your shoulder. Then it drops even farther. It drops even farther down, creating your head, coming back to the same price level. And then it drops even more farther, creating your third, your next shoulder. And look, you got the neckline right there is where you want to enter for a buy, because, you know, the inverse head and shoulder usually signals the end of a bearish market and the beginning of a bullish market. So you guys keep that in mind, you know, and whenever you see these patterns, you know, the alarm in your head should go off like, hey, you know, it's time to, you know, make some pips. All right. Okay, so another pattern that I want to talk to you guys about is called the saucer's bottom formation. And there's also a rounded top, which I'll get to after I talk about the saucer's bottom. So the saucer's bottom can oftentimes be embedded within the head and shoulders formation. And it just, I mean, it's really, you know, just how you look at it, you know what I'm saying? Because, you know, either way, if you see a pattern that's highly probable, you know, you're going to make a profit off that. Now, sometimes a pattern could be within a pattern, you know, but you always want to go with the pattern that's the most probable. So if I were to have a head and shoulders inside of a saucer's bottom, well, I'll be looking at the head and shoulders, because the head and shoulders, in my opinion, is more probable than the saucer's bottom, okay? And so, so here in this example at the bottom left, you have a saucer's bottom. So what that pretty much is let's say market comes down, it drops, and then it kind of just consolidates within a price zone, you know what I'm saying? And in the meantime, it's creating like a little circle, like a little bottom, you know what I'm saying, a rounded bottom. And then they'll come out of that for a bullish run. So usually while it consolidates, it can create another pattern. So it can create a W, or it can create, you know, a shoulder head shoulder, inverse shoulder head and shoulder in this case. And, you know, you can just do that, look off of that. But sometimes there's no pattern that's formed that we're familiar with, and it'll just look like this. And so, you know, that's a perfect saucer's bottom. That's what you call a saucer's bottom. And you'll buy out that because market has dropped, has done its consolidation, and right at this neckline is where you want to make your buy, because saucer's bottom usually signals the end of a bearish run and the beginning of a bullish run, meaning that we should start to buy. So right at this neckline is where you want to make your trade, your buy trade. And so here's an example of how it would look in the market. So price comes down, and you know, it kind of, you know what I'm saying, drizzles downward, downward, downward. Then it starts to drizzle upwards. And as you guys can see, you know, bam, right when it hits that neckline, that's where you want to make that entry. And sometimes it may drop a little bit more, and that's what you call, you know, drawback. But you know, if you have the right risk management and and your stop loss is set right, then you know you should be good. And you know, if you see the saucer bottom, bam, it should work in your favor. So opposite of a saucer's bottom, so you remember how when we had the head and shoulders, we had an inverse head and shoulders. So it's the same thing here. So we have the saucer's bottom, but opposite of the saucer's bottom is what you call the rounded top. And so a rounded top is just opposite. So like price goes up, it's in a bullish run, and then it kind of drizzles a little bit, and it starts to just slowly reverse. It's kind of like when you throw a ball in the air, okay? The ball reaches like a certain high point, and then it starts to slowly come down, and you want to enter off the neckline of that pattern. So the rounded top is usually signaling the end of a bullish run and the beginning of a bearish run. And so just think of it like that when you guys are, you know, seeing these patterns. All right, so let's talk about candlestick patterns in the market, okay? So, man, there's like so many different candlestick patterns that, you know, you guys can see, you guys can look at. I actually send you guys a template of like, I mean, almost 100 different candlestick patterns, from the highest probable to the least probable. But the most important candlesticks, based on the way I trade, are these as you see them here. And there's a couple of more I'll go over, but you know, these candlesticks are very, very important to me, because they let me know. I mean, they're probably the most probable out of all the other patterns I just showed you, because they let you really know, like, okay, what's really going between the bulls and the bears, between the buyers and the sellers. And so when I refer, like when you hear like a bullish market, you know, that means like a lot of buyers are in that market, meaning that people are buying. A lot of people are buying, driving that price high, right? Now, when you hear about bears, you know, or a bearish market, you want to think about selling, because the market's now dropping, and you know, a lot of people are selling. Okay, so this just those are just 2 tips. But okay, so also know that candlestick patterns are also referred to as price action. And so when somebody says, you know, look at the price action at this certain area, well, this is what they mean. And let me go back to this example that I showed. Okay, cool. So you see these circles here? Look at the price action. You feel me? Like, that's what tells you, like, yo, price is struggling at this area. And so let's say I was just talking to you, you were talking to one of your trader friends, and you want to sound cool, you know, and up to date, and you just mentioned, hey, look at this price action. You feel me? Look at this price action around this certain level, and that's just even more confirmation that, hey, this price is going upwards because it's creating a bullish stamp. So keep that in mind. Like, these patterns actually that you guys are seeing are the same patterns that I just showed you. If I were to go back to, you know, that chart where the candlesticks were at, okay? Because look, especially right here, let's just use this example. Look at this. This is what you call a morning star, right? Price comes down, creates a morning star, and then reverses off of that. And so morning stars usually signals the end of a bearish run and the beginning of a bullish run. So let's go back to here, and there it is. Look at that. that's the morning star right there that you just seen. So they actually have the examples in them too. So like price comes down, creates that star, and then reverses off of that. And so that's another pattern that you guys can use. These are just my favorites, but there's other patterns out there too that maybe you guys would like to come accustomed to. But for the most part, these are what I use. And then there's a little bit more that I'll talk about later. Okay. So let's talk about the evening and the morning star. Okay. And so, when you hear evening star, you want to think the opposite of the evening star is actually the morning star. All right. So, as usual, candlestick patterns can also be referred to as price action and can be used to signal the end or the beginning of a bullish or bearish pair. All right. So, as you guys can see, like, the evening star in particular has this long wick. You know what I'm saying? This long wick. And that's, the longer the wick, the better. Like usually when you see long wicks, that means that depending on the direction, it just symbolizes the market's last stride that agreed to a certain price level. And depend like I said, depending on the direction of the wick could determine whether the bulls or the bears have won. And so let's look at this evening star, right? Price coming up, right? And then price comes up, okay? And then it comes back down to this red candle. So that means that, the bulls were winning at first. The bulls were winning when they went all the way up. But then the bears took over. And now the market starts to drop. And that's pretty much, each candle has like a life history pretty much. And I'll dive into candlesticks, as we go on, probably in the group chat. But I just want y'all to get the basics of how this works. And so these wicks are just crazy important. Usually, like, you want to see them at important levels because that means that price is going to reverse off that level. Okay, so that pretty much just means that the bears won this battle, the bullish lost this battle. Okay, now if you look at the morning star, you see that the price went down, and you see this. It's not a big wick. You want them pretty big. You want them around, 10. Actually, I want to say a wick around 15 to 25 pips long. That's a pretty good one. But anything under 50 pips is good. Over 50 pips, now that's just kind of, what I'm saying, you can still use it and it's still a good one. Don't get me wrong, but when I start talking about other patterns, you guys will realize that, it could kind of affect the way you look at a pattern. But let's look at this morning star. You see price is dropping, right? And it drops, and creates a small little wick. And price, the bears were winning at first, but then the bulls actually overturned, creating this blue candlestick, in turn reversing the market and bringing it back in the upward direction. And so, that's really how you want to look at these candlesticks, especially the evening and the morning star. Those are very, very important. And so, I view the evening and morning star the same as the evening doji star and the morning doji star. Now, the only difference is like the middle candle doesn't have as much of a body to it. And that's kind of, that's actually more important, you know what I'm saying? The evening doji star and the morning doji star actually have more weight to them because of that wick, because of that disagreement. And as usual, candlestick patterns are also referred to as price action. It can be used to signal beginning or end of a bullish or bearish pair. Symbolizes the market's last strike agreeing to a certain price level, and then depending on the direction of the wick could determine whether the bulls or bears have won. And so it's just the same concept I talked to you guys about, but now we're looking more at a wick, because you look at the morning doji star, it's really just almost empty. Like, it was almost neutral where the bears and the bulls, couldn't agree to a certain price level, but, actually went up because of the bear, or actually the bulls, and they were able to win. And it's the opposite here. So even Doji started, the bulls were winning, and then they kind of came to a standstill, but the bears overtook them, and that's when the market started to drop. And so that's pretty much what I'm saying, what price action is all about. It's just showing a visual image of really what's going on with that particular pair. And they are very important. Price action is very important. All right, so here's another candlestick. It's called the hammer. Okay, now it looks almost exactly like that middle candlestick here. When we're looking at the evening star, but it's reversed. It's upside down. And so as you can see, it's upside down, and this is a perfect pattern too. So you see this, the hammer, you want to start looking for like a reversal. Now once again, you want to look at that wick, because that wick is really just telling you the struggle that price is going through. And so as you guys can see, the market was dropping, and it kept dropping all the way down here, but came back up because the bulls decided to take over, and then bam, gave you a bullish market. And so the hammer is also a trend reversal pattern as well. All of these are really trend reversal patterns. So you see these, you want to start thinking about things and keeping your eyes open. Now granted, just because you see a hammer doesn't mean like, okay, well, it's time to buy. There's other confluences that you want to have to kind of give you a better estimate of where the market is going to go. Because I'm going to tell you guys right now, like out of all these patterns, just because you see one doesn't necessarily mean that, okay, it's going to go there 100%, because nothing is 100% the market. But what for sure we want is more clues, because the more clues, the better the prediction. And so that's just something you want to keep in mind as well. All right, so next we have Dragonfly Doji, which is just like the hammer, but as you guys can see, I think it's even more better, because price comes down, and it struggles at a certain area, where it comes down, both stroke, the bears actually start to win it, and it goes all the way down into this price level, but then the bulls just take over, and then it comes right back up. So the Dragonfly Doji is another important pattern that you guys want to look at, because of that wick as well, and it's usually at the very bottom of a reversal. You know what I'm saying? So it's not going to be like in the midst of like candles like these, because there's no reversal like a V-shape ordeal like you'll be seeing in this example right here. Because price aggressively just drops, creates the pattern, and then goes up, and they call that a Dragonfly Doji. So when you're trading, keep these patterns next to you. You know what I'm saying? Also, I recommend getting like a wireless mouse. That way it's more effortlessly. If you have like your fingers on the keyboard and you're drawing stuff out, I wouldn't recommend that. Have a wireless mouse, so you kind of freely willing it out, and just making trades and feeling free. But yeah, that's pretty much Dragonfly Doji. What we're gonna do, we're gonna take a quick break right here. I'm gonna go grab some water real quick. I'm getting a little dry throat, but it'll be real quick, and then we'll resume the session.